That's closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Inez Ferre joins us now with the latest market action. Inez.
Josh, the major averages up for a second day in a row, with the Dow up almost 1%, 0.9%, the NASDAQ composite up 0.2%, and the S&P 500 up 0.3%. We have seen over the last couple of days move lower in the U.S. dollar index. So I'm just going to pull up a 3-day chart so you can see here the U.S. dollar index below 99. That's been supportive of asset prices going higher. Also, taking a look at the sector action, we're seeing energy that has been the leader today, along with financials and consumer discretionary. Within consumer discretionary, you've got Tesla that popped today, up 4% for Tesla. Also, within the Mag 7 stocks, a mixed picture here. You've got Alphabet that's up 1%, but Microsoft down 2% over concerns about its AI sales quotas, dragging on Microsoft. Nvidia down as well. And then just taking a look over at the crypto space, we have seen a rebound with Bitcoin. Bitcoin up 2% over the last 24 hours. I'm just going to pull up a quarter-to-date chart here so you can see the rally that we've seen with Bitcoin since it touched 81,000 in November. It's been quite a rally up to 93,000 now that it's cleared the $92,000 level. Traders are saying that it could make a leg higher towards the $100,000 level. But the one asset that has done very well this year is gold. Gold today also seeing a little bit of gains here, with gold futures at 4,238 per ounce, and silver futures also hovering near highs, Josh.
Thank you, Inez.
Thank you.
Well, stocks closing higher as weak labor market data reinforces bets that the Fed will cut rates next week. Can rate cut expectations continue to be a key catalyst for the market rally? Our next guest thinks so. We have Christian Chan, Asset Mark Chief Investment Officer. Christian, it is always great to see you, my friend. Let's start off here, because you highlight a number of tailwinds for next year, Christian. You say AI spending got higher than normal tax refunds, deregulation, continued rate cutting. Can we pick one, Christian, of those and say, okay, of those, here's going to be the primary driver?
Yeah, Josh,
for risk assets.
I think that's the right way to look at it, because individually, I don't think any of these are game changers. But taken together, I think we'll get a lot of broadening of the equity markets. And to answer your question, I think the AI tech spend is the big story here, not just because of how it will help the economy move forward, but because of what it will do to markets with these top-heavy markets. Right? We just looked at the Mag 7 stocks, and clearly the AI tech spend driving most of that movement over the last several years. So that, I think, will be the big connection to the stock market.
What do you make of how the price action of some of these big AI names? What I mean is, look at the way that Google has done a reversal. Now, it was an AI loser, now it's an AI winner, rocket ship. Or you look at Oracle, on the other hand, AI winner, but then it gets whacked. What do you make of that?
Yeah, I think it's super interesting at this point in the cycle. I don't think we're necessarily in an AI bubble, but I do think that we've entered a new phase in this AI investment theme, in the sense that we saw Meta and Oracle over the last couple months start hitting the debt market to fund some of this AI expansion. And to me, what that means is that we'll see more differentiation, just like you talked about, between the winners and losers. I like to say, and when I talk to clients, that in any arms race, not everybody is going to win. There'll be winners and there'll be losers. And in 2026, I think we'll start to figure out who's who.
The fact that big tech is tapping the debt markets to finance the data center build out, Christian, do you look at that and say that's a concern of some kind, a risk of some kind, or no, they've got the balance sheets for it?
They certainly have the cash generation and the ability to support a lot more debt than they have today. That being said, I do think it is, as I mentioned, a start of a new part of the cycle that I think will force some differentiation. And clearly at this point, not all AI investments and all of these projects will make money.
You also talk here, Christian, about this potential $2,000 tariff dividend. That could be another tailwind. How do you see that? Let's say that plays out. What would that mean, Christian, though, through the lens of what would it mean for the consumer, earnings, the market? How do you try and think through that? Yeah,
one of the things that we've been worried about is this K-shaped recovery, and everybody's talked about it. And what we're seeing is that both legs of the K are getting a little bit thicker. meaning more people are doing well because of the wealth effect in equities. And then more people are struggling because we've seen wage growth, particularly at the lower end of the wage spectrum, start to decline. And as inflation is sticky, I think that will have a really impactful impact on the lower end consumer because of how much they have to spend on some of these day-to-day necessities. So that $2,000 dividend check will be, I think, a boon for them. Long term, I think that's probably not great for the economy in terms of what it does to our debt levels. But for 2026, that could certainly be helpful.
I know you talk about that sort of K-shaped economic reality, the low activity labor market, and the risk you point out of what that could mean for the unemployment rate. How much of a risk is that, Christian, in your opinion?
I think it's a big risk. And when we think about 2026 and the big risks in the equity market and certainly in the economy at large, to me, it's the labor market. We're seeing companies slow down certainly their hiring and firing practices. And what that does is it makes the unemployment rate unusually susceptible to surprises. If we get a spike in layoffs like we did last month, that'll go right to the unemployment rate because you don't have any cushion from incoming job growth.
Let's bottom line this. Where do I want to put my money? You say stay home. Despite higher valuations, the U.S. is the place to be.
I think it is because of the myriad of tailwinds that we see in the U.S. economy. To me, that means the U.S. economy itself will broaden out relative to this year, and that also implies a broadening of S&P performance.
So if I want to stay in the U.S., let's get more specific. Which sectors do I want to overweight, Christian?
I like right now financials because of bank deregulation that I think we'll see in 2026. Healthcare is kind of much maligned because of these regulatory concerns, but that's a nice, cheaper AI adjacent area to play because of the impact that you might have on healthcare. And then I think about all these data centers that we're building and how you have to power them. So energy and energy infrastructure, I think, are other ways to play the AI theme.
Do you, in terms of the healthcare sector, the health sector, do you typically would say, okay, I'm going to move there, valuation, safety, play defense? Is that still the reason people move to that sector, or actually no? It's like something's changed with GLP-1s, people looking for growth. Are the reasons people move into healthcare the same?
I think today it's a bit of everything, but what you point out is what I'm picking up on as well is the ability of AI, the ability of these some of these technologies to speed up the process of developing drugs, custom drugs, all of those things I think will help be a good tailwind for the healthcare sector.
Very last one. So those are the sectors you like. Are there sectors you'd say, listen, I'd probably underweight in 26?
A little concern about the consumer for what we talked about in terms of that K-shaped recovery. Now, it's tough to tell exactly how that will all even itself out, and clearly the consumer sector is really, really broad, but we are quite wary of the lower-end consumer at this point.
The lower end. All right, Christian, always great to see you. Thank you, sir.
Thanks for having me.
Well, turning now to Salesforce, that company's third quarter results just hitting the wire, and Yahoo Finance's Dan Howley has a look at the numbers. Dan.
Yeah, Josh, they were up more than 5% for the moment, and now they're back down, just up more than 3%. They beat on the earnings per share. That came in at 325. The expectation was 286, but they were just at the expectation level of 10.3 billion, give or take a few million for revenue. Now, the big deal here is the outlook, Q4 outlook. The expectation was for 10.9 billion, They see between 11.13 and 11.23 billion. Some of the numbers worth going over. They're seeing Agentforce and Data 360 annual recurring revenue coming in at 1.4 billion. That's up 114% year over year. They also said that the annual recurring revenue for Agentforce surpassed $500 million in Q3. That was up 333% year over year. They also say they now have 9,500 paid Agentforce deals and that they're processing 3.2 trillion tokens. This is all incredibly important for Salesforce, as the idea that AI would come for software and kind of eat it for lunch has been a big concern, and whether or not they could get their customers to buy into the idea of AI agents. And so that's why the whole idea of Agentforce getting that huge growth, that 330%, is so important. And so, obviously investors liking what they see, not necessarily going sideways, but going up and down a bit, but still a very good quarter for Salesforce here.
Dan, you look at the stock moving high in the after hours, but heading into the print, I mean, this was not good. This stock year to date had been shelled. It was down about 30%. Now, analysts are they're still bullish, about 80%. Seeing here, they sell it's a buy. That includes Brent Tillover Jeffries, friend of the show. I know Brent, long-term believer. He was telling his clients into the print, hey, he thinks they can reach double-digit growth driven by agent force monetization. He's looking long-term for improvements in the core. In terms of valuation, after that drawdown, Dan, Bloomberg was noting shares have actually never been cheaper for Mark Benioff's company. But bottom line on this Salesforce debate, Dan, I mean, this bull-bear debate, I'm just interested to get your kind of take there. AI leader, Dan, long-term or no risk here of AI displacement?
I think they're in a good position to grab share, or at least ensure that they continue to stay in the space thanks to their agent force products. And so that's going to be the kind of driving force, likely moving forward, at least as far as the street goes, especially with their intense focus on, or its rather intense focus on AI anything. If a company isn't in the AI space, they get hammered for it. But especially a enterprise software offering. And so Salesforce, obviously, Microsoft seemed like, it came out with AI attached to its products relatively quickly thanks to its open AI agreements. Google's been slowly getting into the space, but nothing near what Salesforce is capable of. And so the fact that they have Agentforce, they appear to be growing it well. I mean, that 9,500 paid accounts, that's not anything to sneeze at. And so, I think that they're clearly on a good path here. We just have to see if the street continues to agree. And, it's not as though Agentforce is necessarily, just came out this past quarter. There's been a lot of kind of, as you said, consternation as to where this goes. And seemingly it's going the right way.
Dan, thank you, sir. Appreciate it. Coming up, Jared Blickery and Kenny Polcari take over for the Trading Pit. Don't go anywhere. The year-end season is here, and we're looking at what should be in your investing checklist as 2025 comes to a close. Let's get to our very own Jared Blickery with a closer look.
Thank you, Josh. Welcome to the Trading Pit. I'm Jared Blickery, host of the Stocks in Translation podcast, and I'm joined by Kenny Polcari, former New York Stock Exchange floor trader and host of Yahoo Finance's Trader Talk podcast. Today, we're helping you get your portfolio in shape for year end. And Kenny, we got a few more catalysts on the calendar. The big one is the Fed meeting next week, but then the lights kind of dim until January.
Yes, they do. And look, I think it's, as the market expects, we're going to get this 25 basis point rate cut. But that's not really what people should be listening to, because I think the market's already discounting that. They really want to hear what Jay Powell has to say about the coming 4 to 6 months. Where does he think the economy is? Where does he think the labor market is? What does he think the pace of further cuts are going to be? And are there even going to be further cuts, or are they going to go into this holding pattern? And look, you shouldn't discount the fact that there are members of the FOMC that have been pushing back on the idea of further rate cuts. Sure. So there's going to be very interesting conversation.
Kenny, I could talk rate cuts with you all day, but we got to get to what investors want to know about their portfolios. And I've got a nice little list here. Let's just briefly review tax loss harvesting. You can, if you have a security or a stock that you own right now, you can actually sell it, and then you can take that loss and possibly offset your tax bill for next year. But you got to be careful not to buy it back for 30 days. Any thoughts on that?
Right. So, well, it's something that as a wealth manager, an asset manager, that's what you do, right? You should take advantage of it. So individual investors should take a look at their portfolio and take advantage of any loss. And if you want to take a gain, you're going to take this loss, write it off against the gain, and then reallocate some of that money into either a new sector, or like Jared said, you're going to wait 31 days and then reinvest it if you like the name that you sold.
All right, now let's talk about rebalancing and reassessing portfolio risk, because that's what investors should be focused on right now.
Right, so you really have to take a look look at the portfolio at the end, you have to see whether you're out of balance, right? In terms of have stocks gone up in value that they've now created a portfolio that's not in balance, or at least not in balance the way that you want it to be. So you should always look to fix that. Now, it doesn't mean you have to sell something. The way I do it is I add new money to the sectors that are now underweight, and then I bring the whole thing back into balance again. So you could do it a couple of ways. That's just the way I do it.
All right, now let's talk about risk tolerance and time horizon, very key concepts that we talk about in trading and investing here. I know you spend a lot of time on this, so break it down for us.
So you really want to talk about time horizon, who you are and who the money is for. You might be in your 60s or 70s, yet the money we're talking about is for children or grandchildren that might be out 15, 20, or 25 years. And so it should take on a different risk profile than if it were for you at that stage in your life. That being said, you should also be aware of the score, the risk score of not only the portfolio, but the individual names within the portfolio. Because every stock, every ETF has its own risk score from 1 to 99. Anything above 71 is further out of is beyond the S&P in terms of risk, right? It gets riskier than the S&P 500. Anything less than 71 becomes more conservative. So you just need to understand how the different names in the portfolio interact to give you an overall score.
And also something key here, some older investors might need cash flow, and so that comes into dividend needs, cash needs, and that's something to start thinking about for the first quarter.
Yeah, of course, it should be something that you're always thinking about, again, depending on who you are and where you are in the life cycle, right? Right now, you might be 60 but fully employed, and you're not looking for dividend income, you're not looking for the portfolio to generate income you're going to take, so you want to have it reinvested. If you have a portfolio that's generating a lot of income, you just want to reinvest it. If it's income you need or want, then you should figure out, what it's going to spin off. You can expect to spend 4% of your portfolio and never run out of money. So $1 million portfolio you'd take out $40,000 a year. So you'd want to get dividends that would pay about $40,000 a year, and then that could go on forever, and you'd never run out of money.
Sounds like a good prospect to me. Kenny, I love breaking down tickers with you, and we can do so in line with some of the biggest themes this year. And we've done this in some other segments here. So I want to hit some tickers that we haven't. And this is Apple. This is year to date. And what I want to point out here is Apple was really late to the party off of those April 8th lows. Finally got started around July, August, and it's been off to the races now, hitting record highs.
Right. It's taken off, right? It broke out. Not only did it break out of the April lows, but then it broke out of back in March, right? We busted up and through that, and now it's part of that AI story, right? We're hearing Apple come out not only at the end of the year, they've got new products, and Christmas season's coming, holiday season's coming, and all that stuff, but in addition, there's a whole AI theme going on with Apple. So look at it now. It looks like it's completely broken out and will continue in this uptrend.
Now let's take a look at another hyperscaler, Amazon, and this chart is really interesting to me. 240, a big level here. Looks like we had a little poke above it. Might have been a false breakout. Nevertheless, we got an interesting trading range we're working with here that I'm seeing.
So I think it was a false breakout because look, we traded up, we came right back down. It didn't even stop, right? It didn't even stop to test it to see if support was there. It broke right back through. So I think we are stuck in this trading range that you see, and you could probably expect it's going to try to hit resistance one or two more times before ultimately breaking out, if it's going to break out. I think it is in the new year, but I think it's going to take us some time to do it.
And so you'd wait until the breakout?
I would wait until the breakout.
Shares.
Now, if you already own it, like I already own it, so I'm just not going to do anything with it, right? I'm going to sit and watch it. But if I see it start to break out, then it may change my mind, cause me to jump in and buy some more.
All right, we're going to stick with the hyperscalers, Microsoft, and this is another one. It was off to the races in April, but it has fallen off its peak now with NVIDIA.
Right, so I think this is just a little bit of gotten dragged into the story that maybe it's a little bit stretched in terms of its valuation. Certainly the fundamental story from Microsoft has not changed, but I do think this whole recent story about the whole AI trade either being in a bubble or being stretched is just taking its toll on names like Microsoft and NVIDIA. I don't think it's a reason to panic. Certainly we're not anywhere near the lows. It's kind of going to consolidate, and here is what it appears to me. But I think you just have to keep your eyes on it. Again, it's a name that I own, so I'm just going to sit and watch and see how it performs.
All right, NVIDIA. We're gonna tackle the OG here. Similar story, similar chart, kind of.
Right, exactly, right. So we saw it's taken off. It kind of, it got itself challenged up there in November. It's backed off. It's kind of holding right in here. You want to watch it. See that line that you just drew?
Yes.
That you want to watch that and see if it holds that level. If it does and starts to trade up again, I think it's going to remain in that channel. And so you just kind of have to watch it. For me, this would be a hold. Again, we own it. I own it. So I'm just going to continue to watch. If it breaks down below here, then I think you have to watch, because then I think there's a potential that it even breaks a September low. That would be something you'd want to keep your eyes on.
All right, let's fast forward to a different sector. This is going to be the banking sector, finance. Here's Bank of America hitting record highs recently to little fanfare.
Right, well, hitting record highs along, if you look at a couple of the other names, you look at the XLF, the financial ETF, it is also breaking out. Bank of America is another one of those names that I own. I like it. I love the fact that, it's broken out here. Not with a lot of fanfare, but I like the way it is acting. And it clearly feels to me like it's in this uptrend. It is certainly within the rails that he just drew.
Yeah, and very similar name here, JP Morgan.
Same thing.
It's kind of broken the uptrend, but it doesn't look like anything critical. It's just kind of consolidating here near the highs.
Right, so what it did was it broke that uptrend, but you see it came right down to that level again that you drew, and now it's bounced off of that. So I think it's going to remain in this trading range, and you're going to want and see whether it breaks up or breaks down based on its next move, right? Whether it's able to pierce up and through the November high there, or whether it's going to back off and come to the November low.
All right, here's another ticker I got from you. I want you to tell me your reasoning on Verizon. Is it for the dividend? What do you like about Verizon?
For me, it's just all about stability and dividend in Verizon. It trades in a very tight range. It pays about a 6.75% dividend. It's kind of it's a big mega cap name. It's very stable. It doesn't, it's not up 150% or down 20% in any one year. It kind of stays stable. But for me, it's all about the stability and the dividend, which I just take and reinvest.
Yeah, very good. We have a little bit of time for the quantum trade here. So IonQ, and this is a multi-year chart here. This goes back, I believe, to their IPO. Let me just dial up the year to date. And there we go. Bounce kind of came back to break even. And it's very volatile, but
it's a very volatile name. It's in the quantum space. And so quantum, I think, is going to be a big theme going into 2026. It's already a theme now in late 25, but I think as we continue to get on that AI narrative and that AI trade, you're going to see specific quantum names. And IonQ is a name to watch, right? Again, you see how volatile it is. At one point, even just a month ago, it was up about, what was it up? I think it was up about 40%. It's now almost flat on the year, but you see it came right back down and bounced, which is a positive sign, right? It could have easily broken and traded back to the March lows. It did not. So I want to keep my eyes on that. Again, it's a name that I own, but if it breaks below this line, then I'm going to look to add.
Another quantum trade, surprise, and we only got 30 seconds. IBM.
I love IBM.
Big Blue. Let's do it.
Right. I love IBM. It is a large mega cap name, takes you all the way back to the 1960s. Look, it's
there
had
you go, the 1960s right here.
Yeah, it's had its great move. And what a lot of people don't recognize, besides being also a good dividend payer, it's got a lot going on in the quantum space. So if you want quantum exposure with a more stable name, IBM's the way to play it.
All right, back to you, Josh.
Thank you, Jared. Thank you, Kenny. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. And I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.